Hello, everyone. This is Nicole Teska, and I'm joined with Bob Teska. We are both partners at Bowers & Company CPAs. This webcast is another installment of the Bowers & Company Current Events series, which is meant to keep you informed on the recent developments as we learn them. Just as most of you in the country have recently had some restrictions released, which has allowed you to finally leave your home, the government has been very busy doing their own releases and have released a plethora of information that has drawn us all back to our desks. So that being said, let's get started on all of the new information that has come through in pretty much the last 7 days. There's been some frequently asked question responses from the Treasury on the Paycheck Protection Program, IRS Notice on the deductibility of those expenses, the SBA guidance on loan forgiveness, and then the HEROES Act.
All right, so with that, let's get into it, Nicole. I've got a few questions for you. I'm hoping you can provide some clarity on. When the CARES Act first came out, it was pretty well laid out that if I had laid off an employee and then brought them back during my 8 weeks after I received the loan, they would be counted as a full-time employee for the whole 8-week period. So I wouldn't be penalized for the time that they may have missed while they were laid off and my business was recovering.
Right.
But with the concerns of possibly getting sick, and also with the significant pay that you can receive on unemployment with the extra $600 that the feds are kicking in, a lot of employers have been in the situation where they tell their employees that they've got a job for them, come on back, and they're declining. In that situation, does that go against my full-time equivalent calc?
Correct. So the Treasury must have gotten that question just as many times as us accountants have, because they did give a response to that. So they came out and said, if the borrower made a good faith effort and a written offer to rehire the employee, and the employee rejected that offer, and that rejection must be in writing, then the employer qualifies for a full-time equivalent exemption in their loan forgiveness calculation. But what the Treasurer wants everyone to know, employees and employers should be aware that employees who reject that offer for reemployment, they may forfeit their eligibility for continued unemployment compensation.
All right, so it sounds like I'm not going to be dinged if my employee decides not to come back, as long as it's documented.
Correct. It always comes down to the documentation. And then in the additional loan forgiveness guidance that came out this weekend that we'll talk about in a little bit, they came out with some other exceptions to the full-time equivalent reduction. So in addition to this one where you offer them a job, they refuse, and you have it all documented, if you fire an employee for cause, I know that was a question we got a lot during this period.
Yep.
You know, someone's just not performing and you have to fire them, but you don't want to hurt your calculation. There is an exception for that, as well as an employee who voluntarily resigned, or an employee who voluntarily requested and received a reduction in hours. If you can document those things and prove it, that will not hurt you as well. However, obviously you couldn't have brought someone in to replace them because you wouldn't have been down the employees. So as long as those employees aren't replaced and you can document it, you won't be dinged because of it.
Gotcha. So either don't bring them back, and if you replace them, then you're still not dinged.
Correct.
Good. All right. Another question we got quite a bit related to seasonal employers. We have a large client base up north that can be seasonal with cottage rentals related to the summer season. And that was related to if they had used a 12-week calculation instead of the 8-week on the loan application. Is it possible to still meet all the required certifications on that application because of the different date ranges?
Correct. So the Treasury said, as long as you're signing that certification and you're certifying to the rules that were in effect at the date you signed it, you won't be held responsible, or however they want to phrase it for you. So for the SBA and the Treasury came out with guidance on April 27th, saying that you could use an average payroll from a 12-week period if you're a seasonal employer, for a 12-week period beginning May 1st, 2019 to September 15th, 2019. That was your measurement period for the loan proceed amount. So if you obtained a loan after April 27th, when the additional guidance came out and you did the 12 weeks, you can still certify that everything was appropriately related to the rules as you knew it as of that day.
Gotcha. So that's some good relief granted to the seasonal employers.
Absolutely, especially because now we're getting into a period where the original calculation didn't really qualify, because the original one was an average 8-week period from March 1st to June 30th. But some people didn't have those people in effect on March 1st. They might not have started till May. So to be able to use a different time period to be able to figure out the loan proceed amount was definitely a win for those seasonal employers.
Oh, that's all good. All right, so the next one, this was a big one that caused a lot of concern for a lot of clients and non-clients alike, I heard from. So when people completed the loan application, they had to certify that, and I'm quoting this right from the application, that the current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. And that's what you certified to. No clear definition as to what that actually meant. There was a lot of uncertainty related to that when we got into news stories about places like the LA Lakers, Shake Shack, and I think Harvard, who had applied for this loan and then were essentially shamed into getting it back. And so that made people nervous about maybe they might have to give their loan proceeds back, because how do they prove that they had a need for it? And then this week I heard something about $2 million. What was that about?
So you kind of summarized it well. In the beginning, no one knew how to define an economic uncertainty. So we just kind of assumed if you had a loss of revenue or your operations were closed down due to perhaps a state order or quarantine order, that would be enough for an economic uncertainty. But no other additional guidance came out. And then, as you said in the news, all these publicly traded companies came out and said, they received 6 million, 8 million, 10 million. And that obviously wasn't the intent. So then Mnuchin came out and said, if you received a loan over 2 million, you're going to have an audit, but then they never really clarified what that meant. But they gave you an opportunity to return it, but you didn't know if you needed to return it, because they still didn't define economic uncertainty. So for a while there was a lot of back and forth, and people were nervous. Should I give it back? Should I not? So what they came out with a few days ago was that if your loan, together with any affiliates, so the affiliates you might have listed on your application, together with those, if the loan amount was less than 2 million, then you qualify for a safe harbor provision. The SBA felt that if the loan was under this threshold, that it was less likely that you had adequate sources of liquidity in the current environment to be able to get other funding sources. So it was good for those that had the lower dollar amount loans to now feel like, okay, I don't have to prove it. I don't have to go through an audit. I don't have to do any of this. I can just be safe harbored in and continue to pay my employees.
Right. So it's a bright line test that just assumes that you didn't have additional sources of liquidity to leverage.
Correct.
Okay. So does that mean if my loan was $2,001,001, I should cut a check back to my bank?
Nope, not necessarily. So if your loan is over the 2 million, but you still feel like you had an adequate basis for taking that 2 million, then you should, get out your Microsoft Word doc and start documenting some notes about, if you had been impacted by a stay-at-home order and you had to lay off people. If your revenues declined because, you were in markets where that was an issue. Start documenting these reasons why you felt you qualified for that loan. And
would another consideration be how much access you had to additional capital? Yep. Maybe you're pretty leveraged in obtaining another bank loan, or maybe even accessing a line of credit wasn't possible.
Correct. Any documentation you want to make for why you felt you needed this loan, either liquidity wise, revenue decline in revenue, business shut down, all those things, get them on paper, document them. And then when the 8 weeks is up and you're applying for the forgiveness, the SBA will look at any loans over 2 million. They are going to take a deep dive into those to make sure that the loans were in compliance with the program requirements. So that will be one of the things they look at. And if they agree with you, then, there's still a chance your loan will be forgiven. If they don't agree with you, then they most likely will not forgive that loan and you would have to pay it back, but you can pay it back without penalties, assuming you had, sufficient evidence for why you supported your claim.
So it's probably best if you're in that boat where your loan's over $2 million, you should probably get with your CPA, possibly your attorney, and to create a file to support your position.
Agreed.
Okay, good. I think the last thing I got in this section is if I'm a company and I am concerned that I might have requested this loan inappropriately, i.e. maybe I had other liquid sources, what should I do?
So as we were stating, if you think you could, if you're over 2 million and you think you can prove why you needed it, continue on with the process. If you acquired this and you really can't prove you had a decrease in revenue, your business wasn't shut down,
Banks
you had
to lend to you.
You had other sources, other options to get money, then they're giving you until May 18th, which is today, to be able to return those funds without penalty.
So is this question pretty late for us to answer?
You know what? They have extended this deadline about 5 times, so perhaps they'll extend it again. Who knows? But as of the current guidance, as we understand it, which has been our caveat throughout this whole process, is as of May 18th is your current window to be able to return the funds. And if you do think you fall in this boat, talking to your lender would be the first step.
Gotcha. Okay.
All right, some other guidance came out related from the IRS actually, that says a taxpayer that receives a loan through the Paycheck Protection Program is not permitted to deduct expenses that are normally deductible under the code to the extent the expenses were reimbursed by a PPP loan that was then forgiven.
So, I think this was disappointing when this came out. As I read the CARES Act and, the provisions in the PPP, I thought it was pretty clear that what the lawmakers were trying to do was to create a whole new class of income that wasn't going to be taxable. And it was, this program was designed to be of significant benefit and not a negative at all to companies, where they were going to get a capital infusion, allow them to retain their employees, allow the employees to earn money so that they can put that back into the economy, and then the added benefit to the employer was going to be that those loan funds that were forgiven weren't going to be taxable. It was a win-win-win as I read it.
Correct. That was the way I think we all read it, was their income was not going to be taxable when it got forgiven and you could deduct your expenses.
Right. And then, so this comes out and essentially, I'm going to say it neuters the bill a little bit. And
How about neutralizes?
It makes it, it makes it neutral, where, okay, the income that's forgiven, the loan that's forgiven, that part isn't taxable to the extent that you're going to have expenses to offset it. So it's not that income's not taxable, but neither are the expenses deductible, and it makes it kind of neutral. Not the worst thing in the world, but I don't, as I read the CARES Act, I don't believe that was the intent of the lawmakers.
And as the other comment we have up on the slide here, I don't think, yes, the other senators or congressional leaders felt that way either. There was a statement from Chuck Grassley pretty much saying that was not the intent of the bill, but the IRS came out later and said, hey, that is the intent of our law. We had this on our books forever. If there's certain income that's being used for expenses, you can't double dip and take the expenses too if you're not taking the income. So it's kind of at a shootout between the two systems right now. If the IRS has its stance on where it stands and Congress wasn't the intent. So I think if anything's going to change, Congress is going to have to make a law to regulation to change it.
Right. And last week we sat in kind of a town hall that the AICPA put on, and they were talking about this point in particular. And they had discussions with lawmakers, and they indicated to us, the audience, there was already talk about walking this back. and creating a law that would essentially bypass the IRS notice, which would be a good thing.
Correct.
But that's to be determined at this point.
Correct. So as of right now, it's almost like you didn't get the money and you didn't spend it.
Correct.
So we shall see.
All right, so Friday evening, the SBA released the application for loan forgiveness, and with it, they provided some guidance. I'm going to stress some because there's still some stuff that needs to be clarified in it. Also going to say that we're only going to cover the highlights here because there's enough information that was released that it's going to warrant its own webinar that I expect that the firm will put out sometime in the very short order. But we did want to cover the highlights. So why don't you ask a few questions?
I can. So I think everyone knows that the 8-week forgiveness period started when you received the loans. But there was always some hesitation because, well, what if I paid my payroll on Thursday, but now I'm actually getting my loan proceeds on Friday? That doesn't seem fair that I can't count the ones that were literally paid less than 24 hours ago. So this gave some guidance. So what do you do if your payroll period doesn't coincide with the loan proceed date?
Yeah, this was definitely a big question as people were kind of trying to figure this out, asking questions about forgiveness that we couldn't answer because we had no guidance. And this is, the law or the guidance described it as to provide administrative ease. They're going to allow you to select an alternative covered period that essentially shifts your 8-week period to coincide with the beginning of your next full pay period. So if you got the loan proceeds on a Friday, but your pay period starts on a Tuesday and you kind of missed it, you'll be able to shift it to start your covered period to the following Tuesday. So it just administratively allows you to track the accounting of this in a complete 8-week payroll period.
Which is a very nice, nice add-on that they did there.
Yes, it is.
All right, can you remind me what costs are eligible for the loan forgiveness? And, in addition to perhaps payroll not matching up, what happens if I paid my rent the month before I received the loan proceeds?
Yeah, those are great questions. And there was a little bit of guidance given here that I think is going to help most people out. So just as a quick reminder, your eligible payroll costs are going to be your gross wages, tips and commissions, the health insurance premiums paid, the retirement plan contributions, and your SUTA expenses. So again, that's going to be over that 8-week period. But what they did is they went further and they defined it so that it's going to be costs paid and incurred during that covered period. So essentially, it's going to allow us to work on the accrual basis of accounting here. So if we get to the end of the 8-week covered period and you haven't paid out that last payroll yet, it's going to allow you to include that last week that was incurred and would be paid out the following week. This is beneficial if you're paying people every 2 weeks or bi-monthly. It allows you to get a full 8-week period in that covered period.
Right, so now people who were in the middle of that 2-week pay period, when the 8 weeks is up, we can now extend it through the next one, but it has to be paid in short order after that 8 weeks is up. Correct.
It's got to be paid on the next scheduled pay date. So you can't incur it and then not pay it for a month. It's got to be, the next scheduled pay period. So if you were a monthly employee, a lot of salespeople I know get paid monthly. It would have to be paid on the 1st or the 30th of the next month. So, but it allows you to get the full 8 weeks of payroll in there. And then in similar fashion on those non-payroll costs, just again, a quick reminder, it's going to be mortgage interest, again, not the principal, just the interest with no prepayments, just what was due over those 8 weeks. Your covered rent obligations, where you had a lease agreement in place before February 15th. One thing that they did expand on here as they said it was on real or personal property. And that would lead me to believe that if you're leasing equipment for the business, that those lease payments are now going to be allowable.
As long as they were enforced before February 15th, 2020. That's how it makes it sound.
At the moment.
At the moment.
Subject to current guidance and interpretation, but I mean, they did add that, which seems to me as a clarification that the intent was real or personal property. So I think that's fantastic for companies who are going to be struggling to spend that 25%.
Correct, because the original guidance really just said rent or lease payments. So it left us all accountants wondering, okay, is it just on a building lease? Can it be equipment? But now that they gave additional guidance saying real or personal, that is good news.
Right. I mean, if you're in New York City, your rent on your building alone probably would account for 25%. But in areas where, we are, covering that 25% for some companies was going to be challenging. So this will help. And then your utilities that you began service, again, they have to be in service by February 15, 2020, include your electricity, gas, water, internet, phone should be in there. And then transportation, which transportation is yet to be defined. So I don't know if it's fuel costs. I don't know if it's freight. I don't know. It just says transportation.
Right. Well, let's hope now everyone has enough in lease payments. We don't have to worry about that.
That's true. And again, these are all costs that are paid or incurred. So depending on where your rent falls out, your rent payment, you'll be able to include 2 months worth in your loan forgiveness calculations. So that's great guidance.
Correct. Very helpful. And I'm glad that they saw the way most of us accountants were seeing things, that it should be either paid or incurred. So that's really great from them. All right, another question. Did the loan forgiveness application clarify at all the definition of a full-time equivalent? That's another one going back and forth a lot.
Actually, it did pretty well clarify this. I'm going to say ironclad. A full-time equivalent employee is one full-time equivalent employee is equal to 40 hours. So if I have a guy that works 40 hours in a week, he's one full-time equivalent. If you're working 20 hours, it's a 0.5. It does say that you round to the nearest tenth to the nearest tenth. So you can round up if you end up with like a 0.75. So a couple of quick examples. You're going to look at the average number of hours per week during the covered period and you're going to divide that by 40. So if you add up all the hours worked during the 8-week covered period and you end up with 320 hours, you divide by 8, that equals 40. You divide by 40 again, that equals 1. That means that employee was one full-time equivalent employee during that time period.
Make sense?
Yep. If you had someone during the course of the 8 weeks that worked 240 hours, divide that by 8, that's 30. 30 divided by that 40, that equals 0.75. Now we get to round up because we're rounding to the nearest tenth here. So that person that only worked 240 total hours during the 8-week period, he's a 0.8. And then if you have a person that worked 400 hours, you divide by 8, that equals 50. So then 50 divided by 40 equals 1.25. We don't get to round here. We don't get to round up. We can't have a number any larger than 1. So that 1.25 becomes 1.
That was a little discouraging that the guidance came out and says that the max an employee can be is 1, seeing as some people are working overtime to cover those people that might not want to come back, or that just to cover the shortfall.
Correct. I hope there might be a correction on that, but I don't know that there will be. Thus far, no one's talking about it. Maybe they will going forward as this has just come out. And then they did allow for a simplified method for full-time equivalents, where if you have an employee who works 40 or more hours, we assign them a 1. And then if you have an employee working less than 40 hours, you just assign them a 0.5. Depending on how many employees you have and the number of hours they work, this actually could work out really well if you have a lot of part-time employees. Just to assign, if you have people working under 20 hours a week, 18 hours a week or something like that, assigning them a 0.5, you would actually end up with a higher number here. So this could work out to the benefit.
Correct. All right, so this was a SBA loan forgiveness application. So did the application say at all what I have to submit with the application, whatever documents I might have to support these numbers?
They did, and they gave suggestions, really how I read it, and I do believe this is probably going to vary by bank, just like the support for your loan application varied bank to bank. So again, we're going to say check with your bank on this, but as far as examples, and I think this was pretty clear to begin with, and we've probably talked about this with most of our clients, but to support your wages, they're going to be looking for bank statements showing the funds being withdrawn and or third-party payroll statements. So if you're using an ADP or a Paychecks, I'm sure they're going to produce reports specific for this. They did list 941 or your New York 45s. I don't know how useful that's going to be because depending on your 8-week period, you could straddle 2 of them. The quarterly report, so they're going to have 3 months on there, but we're only looking at 2 months. So I'm not exactly sure how useful they're going to be, other than a bank might just want to see them just to show that you actually don't have false payroll reports, I guess.
Yeah, probably just to make sure your wages kind of match up with what your payroll reports are saying, so you didn't manipulate your payroll reports.
Yep, I can go with that. And then, of course, they're going to be looking for proof of payment. So canceled checks or electronic receipts for your health insurance and your retirement contributions. For full-time equivalents, they listed, again, your payroll reports, so 941 to New York 45s. However, I think that's probably easiestly going to be supported by your payroll reports, again, from your third-party payroll vendors or something out of QuickBooks if you do your own payroll. I have to imagine, like an ADP or a Paychecks, they're going to provide reports specific to this, like they did to support the loan application.
Correct. I know they ran, the number of employee reports so people could make sure they were under 500 for the application. So I'm sure they'll be all over how to do the full-time equivalent once they get this guidance. But for people that don't use an ADP or Paychecks or a third party, the SBA, as part of the application, provided a application sheet you can use line by employee to fill out to submit for it if you don't have a provider that can do that for you.
Nice. And then for your non-payroll costs, it's the items that you would think you would need. For your mortgage and interest, they actually suggested an amortization schedule and then payment, or to confirm payment. So it would be like a payment receipt or a canceled check. For your rent or lease payments, they're going to want a copy of the lease and then payment receipts and canceled checks. For your utility payments, this was interesting because they said they had to be in service by February 15th. They're going to want a February 2020 invoice to prove that it was in service, and then copies of the invoices during the covered period where you're claiming the expenses. And then also payment receipts or canceled checks.
Makes sense.
Yep.
So it sounds like they've answered a lot of questions with this guidance, but we still probably have a couple, but I think it's enough. People can start at least having a better idea of how these numbers are going to work out.
Right. And then again, when we do the full webinar just on this topic, we'll walk through the loan forgiveness calculation, what's going to go into it. I imagine we'll have some tools and it'll just break it down in a lot more detail.
Agreed. The HEROES Act. So the status as we understand it as of Friday, May 15th, it was narrowly passed through the House. And I do believe the Senate's going to shoot it down.
Right. I believe I read something Mitch McConnell said that this is essentially dead on arrival when it gets to the Senate. But I think it's important to at least spend a minute on this because I think there might be some trial balloons in here where they're floating some ideas that we're going to end up seeing in some bills that do get passed. And there is some stuff that relates to PPP that could be very applicable. Understanding that none of this is final from this section forward, this is what's being discussed in Washington.
Right, it's what's in the current bill, but not necessarily what will be in the final bill once it all gets passed.
Correct.
And everything we have listed pretty much relates to the PPP, since that's pretty much the topic of discussion these days. So perhaps extending the cover period from June to December, which would be good as we slowly are starting to get back into the economy.
Yep.
Perhaps extending the maturity date of the PPP loan to be 5 years instead of 2, that would be good.
I think that could be good, especially if we end up with, people end up with a large amount that's not forgiven based on how they bring employees back or whatnot. So having a 5-year maturity, I think would be very beneficial to people.
And then a couple things on the forgiveness side of it. Perhaps instead of having the 8-week pay period, have it be 24.
Right. I think that'd be very beneficial. I mean, they're talking about, restaurants coming back maybe first at 50% capacity. You're not going to need all your employees. So, I mean, being able to have a longer period of time to spend the funds on appropriate expenditures would be very beneficial.
Especially if some of those restaurants aren't opening until phases 3 or 4 depending on what state you're in.
Right.
It harmonizes the use of proceeds with forgiveness. So in the original CARES Act, it said the loan could be used for certain things, but there was a couple things that didn't match up with how it would actually be forgiven. So to tie those together would be nice.
That's just a technical correction there. That's going to pass in something, I'm sure.
I mean, the biggest one was the act said you could use the proceeds for other, not just mortgage interest, but other debt interest, but you can't forgive that now. So I think that was the biggest one to try to match up to see which way are they going to go with that. And then possibly eliminating the 75-25 rule between payroll and non-payroll.
That would be beneficial, especially in places that have, much higher overhead rates than, we do locally.
Mm-hmm. And then, currently right now, if you have a PPP loan, you are not eligible for the employee retention credit, which allows you to forgive about $5,000 worth of per employee for employer tax credits. There's a possibility you might be eligible for that if the PPP. I'm not sure if that will actually go through or not, but we'll see. That's something else they're discussing.
Right. And a shout out to the Committee on Small Business for all these bullet points.
Yes. I'm glad someone can summarize 1,800 pages because I certainly was not. All right, well, we hope you found this helpful, and be on the lookout for any future guidance we have on the loan forgiveness calculation that